Welcome to the Eggs Invest podcast series, where we explore smart, practical strategies for successful residential property investment across the UK. I'm Anna, your host here at Eggs Invest, and today, we're diving into something that can really make or break your journey as a property investor: how to access capital, understand your returns, and make your money work harder in the real estate market. Whether you're looking at your first buy-to-let or already growing a small portfolio, knowing how to structure your financing and measure performance is key. So let's break it down, from banks to projections, and most importantly, maximizing your returns. Let's start with the basics. Where do you get the money to invest in property? For most of us, the first stop is the commercial banks and financial institutions. These are your traditional lenders offering buy-to-let or residential mortgages. Now, if you're investing in residential real estate, you'll typically go for a buy-to-let mortgage. These loans are designed for rental properties and usually require a 20 to 25% deposit, proof of projected rental income, and a decent credit rating. But banks aren't your only option. You can also explore building societies, specialist property lenders, bridging loans for short-term needs, and even peer-to-peer lending in some cases. Each option has its own pros and cons, and it's all about choosing what matches your strategy and timeline. For example, if you're buying a fixer-upper, a bridging loan could be a quicker path before refinancing later on a standard mortgage. The key is to approach lenders with clarity, know your budget, know your property goals, and have your numbers ready. Now let's talk about returns, because getting access to capital is only half the battle. What really matters is, what are you getting in return? In the UK, we typically look at two key types of property yields. Gross yield, this is the annual rent as a percentage of the property price. It gives you a surface-level idea of return. Net yield, this digs deeper. It's the rent after expenses, like maintenance, management fees, insurance, divided by the property value. This one gives you a more realistic view of your income. Let's say you're earning £12,000 a year in rent on a £200,000 flat. That's a gross yield of 6%. But once you factor in £2,000 in expenses, your net yield is closer to 5%. That 1% difference may seem small, but over time, it really adds up. Then there's ROI, return on investment. This looks at how much money you've actually put in, think deposit, refurb costs, legal fees, and what you're getting back. It's a great metric for comparing deals. So if you put in £40,000 total and make £4,000 a year in profit, that's a 10% ROI. Not bad, right? But here's the trick: don't just chase high numbers. A cheap property with high yield might come with high risk. Always balance cash flow with long-term growth and location quality. All right, now we're getting into the fun part: how to actually maximize your returns. There are a few ways to do this across different types of real estate, but if you're focused on residential, here are some proven strategies. Add value, think about improvements. Can you renovate? Add an extra bedroom. Upgrade energy efficiency. Properties that are well kept attract better tenants and higher rents. Reduce void periods, empty properties eat into your profits. A good letting agent and proactive management help keep tenants long-term. Consider HMOs, houses in multiple occupation. They are more management-heavy, but often generate higher monthly income than a single let. Refinance smartly. Once you've improved a property and its value rises, you may be able to refinance and pull out equity, which you can then reinvest elsewhere. Stay tax efficient. This is a big one. Consider using a limited company structure if it makes sense for your long-term plans. It could help with tax efficiency depending on your income bracket. Maximizing return is about squeezing every bit of value without sacrificing quality. Think of it as long-term stewardship, not short-term gain. Now, if there's one habit every property investor should build, it's projecting your cash flow before you buy. This means looking at your mortgage payments, expected rent, operating costs, letting agents, insurance, repairs, emergency reserves. Run these numbers across best case, expected, and worst case scenarios. If you can still survive the worst case and stay cash flow positive, you're in a good place. One thing to remember, rent can fluctuate, especially in cities where tenants come and go more frequently. So always budget conservatively. Don't just ask, "Can I afford the property now?" Ask, "Can I afford it if interest rates go up? If repairs cost more? If it sits empty for a month?" Lastly, let's talk about ongoing performance. Owning property isn't passive, it's a business. And like any business, you should track performance. This includes regular maintenance to retain value, upgrades that reduce energy costs. EPC ratings are huge now in the UK. Staying on top of tenant needs and legal compliance. A well-managed property doesn't just retain its value, it builds it. And if you're thinking long-term, keep an eye on local developments, new transport links, or school ratings. These all affect demand and appreciation potential. So to wrap up, know your funding options and approach lenders with a clear plan. Understand how to calculate and interpret yields and ROI. Use smart strategies to maximize returns, not just increase rent. Build detailed cash flow projections and prepare for market shifts. And treat every property as a performance asset, not just a purchase. Getting the capital is just step one. Managing it well is where the real wins happen. Anna, warm, closing tone. Thanks for tuning in to today's episode of the Eggs Invest podcast. If you found value in this, don't forget to subscribe, leave us a review, and share it with someone who's thinking about jumping into UK property. I'm Anna, and until next time, invest wisely, plan smart, and keep those eggs in the right baskets. See you soon.